Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and I am here with Daniel Romberg, and we are talking about infinite banking in retirement today. So we just filmed this, and it was a really good video. Went a little bit of a different direction than I expected, honestly. But that's how today's gone as we filmed in this studio. So I think you're going to enjoy it. Looking at the timer here, it's a shorter one. It's like 20-ish, 22, 23 minutes long. So I think it's going to be a lot of fun. And more importantly, I would really encourage you, if you're somebody who's in infinite banking, this video is going to challenge, I think, a lot of other people's perspectives in some interesting ways, because it's not super technical. It's not all about all the traditional infinite banking talking points. I think it's actually so much bigger than that. So I hope you enjoy.
This is exciting because I get to combine two of my favorite topics together, Chris. And I have you and I pride myself in, trying to learn as much as I can about retirement.
Yep.
You're someone who is incredible in the whole life space. So we're taking my two favorite topics, merging them together, infinite banking in retirement.
Love it.
I can't wait. So when I think of infinite banking in retirement, I have my idea of that.
Yep.
And I definitely have a lot of use cases for life insurance to help people make their retirement more efficient.
Mm-hmm.
We were going through a Ernst & Young white paper earlier about all the different ways life insurance it makes your retirement more secure and beneficial.
Yep.
Our friend Tom Wall wrote an amazing book and has done study after study showing it.
Mm-hmm.
To me, and I'll just simplify it like this, and I'm going to turn it over to you.
Mm-hmm.
I view life insurance in retirement as like, I'm trying to think of a good analogy for it, but it fills in all the cracks. Like it's like something you can like pour in and it's going to solve a lot of different problems. Like you can help it for income replacement. You can help it for a buffer asset. You can help it for cash flow, replacing benefits. Like it's going to do a lot of different things in your retirement. But I want to get down into like some of the specific ways it can really benefit you and where you're using it for people in retirement. Yeah,
I think how you utilize the whole life policy is going to be dependent on where you are and when you started, right? A lot of times I think people, you talk a lot about the accumulation and then decumulation phase.
Yeah.
Right. At the end of the day, the beauty of a whole life policy is it's going to be able to kind of ebb and flow with you, right? Like as you're accumulating money and you're going through wealth creation, you're going to utilize it in a certain way. But as we get into retirement and we start to decumulate assets, I think it's important to, if you've had the policy for a significant amount of time, and let's say you're utilizing it for real estate and business, you're going to want to make sure your loans are managed and capitalized, back the policy. I'm a believer. My kind of rule of thumb is I want to have 7 years of income in my policy when we hit retirement.
Wow.
That's my rule of thumb.
Okay. Why is that
7 years of income? Well, because I plan on living a long time.
Okay.
And there's a couple things. I've just gone through and done a lot of simulations about what happens, and I just use, quite frankly, myself as a case study, right? And gone through and said, all right, if I have 7 years of income when I hit retirement, we know, and let's say I retire, I'm saying at 60, I want that money, and I know that money is going to have to. I know that all my money, all my cash flow, all my assets are going to have to be able to weather anything that comes at us, for 40 years. Now, most people don't realize this, but 40 years is a long time, right? Yeah. Like if you live, and there's a good chance, especially by the time we hit that age, most people don't think living to 100 is a viable thing.
It's happening more and more.
It's happening more and more. And I think especially whatever, things happen. I could get run over by a bus for all I know, but I live a pretty intentional, pretty healthy lifestyle, so and I think with medical advancements and all that stuff, I think 100 years old is not outside of the realm of possibility. And so that said, even though I'm not going to work straight through hardcore till I'm 60, and so it's not really fair because of what we're doing, but if I were a traditional person working from, say, out of college to 60 years old, that's 35 years.
Yeah.
I've got to have my money last longer than I actually took to accumulate it.
Yeah.
Think about that.
Crazy.
That's insane. Yeah. If you want to have no risk on the table, you know what I mean?
And you know what is also crazy, Chris, that people don't think about in this type of framework is our only one job is to build income.
Totally.
That's your one job, is to build a machine that creates income. That's your only job.
And what's crazy is, since I don't want to go too far down this rabbit hole because it's a total tangent, but what's crazy is ever since the creation of the 401k the defined benefit plan, or the defined contribution plan instead of the defined benefit plan,
right.
people have been failing horribly.
Yeah.
You know, and the defined benefit plans was a world of pensions and a world of, you know, people having it all taken care of for you by the companies.
Lifetime
income. And that's gone away all of a sudden.
Yeah.
But yeah, so that's a whole different, you know, we should probably do a video on that. But here's the way I look at it is I want 7 years of income. The reason is because 40 years is a long time. We're going to hit many market cycles, many down years. If we're utilizing it as a volatility buffer, I want to be able to have access to it. Now, I'm also a believer that when we utilize the volatility buffer with a whole life insurance in retirement, a lot of times when we're talking about taking loans out for real estate, for business, for whatever, when we hit retirement, that game changes. We do typically, and not always, but the rule of thumb is withdrawals up to cost basis and then loans.
Yeah.
Because
a lot of people don't know you can do that, by the way.
Yeah, exactly. And so what we're talking about
is a conservative way to take money out of the policy.
100%. Yeah. And a lot of people are like, why would you ever withdraw instead of taking loans if you can take loans? Well, the only reason you're going to take loans is because the assumption that you're going to have positive arbitrage, which I got news for you. It could happen. We could live in an economic environment, in an interest rate environment where that's a possibility. And if it happens at that point in time, I'll cross that bridge when I get there.
Yeah.
From a conservative perspective, and I want my planning to be conservative because I'd rather have more than less, you know?
Yep.
And I'm going to be conservative like that. So I'm going to do withdrawals up to cost basis because typically speaking, when we're borrowing against the policy for real estate or business, we're utilizing cash flow produced from those assets to recapitalize the policy, right? And so as we do that, we're controlling opportunity costs, and it's a totally different dynamic. As soon as we hit retirement, the objective is to not pay the loan back. Right? So like it's a totally different dynamic. And so now we have to say, well, if we don't pay the loan back, well, that loan is going to compound against us.
Right.
And it's going to create internal fees and costs and charges. So people are like, why would you ever not take the loan? Why would you take a withdrawal? Because you're going to have to surrender a part of the policy. You're going to have to do all these things. Wow. And I got news for you. When you borrow against it, you're reducing the net death benefit anyway, because it's being guaranteed by it. And, you know, so by doing a withdrawal, you're going to reduce the death benefit. By doing a loan, you're going to reduce the death benefit. That just is what it is. But by doing a withdrawal up to cost basis, meaning up to the amount of premium that you've put into the policy, you're able to do that and not have the extra interest expenses that go with it.
Right.
It's going to make the policy efficiency from a long-term perspective be way higher.
By the way, really unique ability to be able to take your principal out that you put in before you take the gain out.
Totally.
That's crazy.
Yeah. Do you want to touch on that a little bit more?
Yeah,
like, because that's huge.
Any financial account that you have.
First in, first out.
First in, first out, right? So, you know, if you're like, take an annuity, for example, right? You're going to put, let's say you put $100,000 of after-tax money in an annuity. Well, an annuity has a tax-deferred feature. So all the gains it's accumulating will be taxable. Well, when you go to take money out of your annuity, they make you take the gain first. You got to pay the tax before you get to your own money. Life insurance, you can do the opposite. You can take your own money out before you get to the gain. That's a pretty unique ability to be able to shift and have more control.
I don't think we talk about that enough, do we?
Definitely don't talk about that enough. That's an
crazy.
Amazing benefit.
It is.
So what gets me excited and where I kind of nerd out a little bit on retirement is like I'm always thinking about ways to improve long-term cash flows, whether that's Social Security, pensions, or annuities, or even just more favorable times to realize taxation through Roth conversions, life insurance through the form of what you can build in a bridge or a buffer asset, as you call it, right? You can take those basis withdrawals or loans to supplement income needs so that long-term cash flows can defer 1, 2, 3 more years and provide more lifetime income for the rest of your life. Amazing benefits to be able to increase income.
And so the reason I think we have to have 7 years is because we're going to live a long time. We're going to have a lot of negative years.
Oh, right.
And we're going to be, and it's not just about what do I want that asset to do for me while I'm alive. It's what am I leaving behind?
Yeah.
And so I want to be able to use it and still have something left behind.
Yeah.
You know, what I want left behind.
Yeah.
You know? And so, you know, 7 years is what I've found to be a good number to be able to tap into it. If, like we talk sequence of returns, if the first couple of years of retirement happen to be down years and you got to tap into it really quickly.
That's a great point.
You know, we want to be able to do that and then be able to have it replenish on the positive years and all these things when it regrows.
The volatility.
They're I mean, I'm not going to be able to run through every simulation and every kind of play
so
out
many
here.
ways.
But to me, what I've found personally is 7 years of income, what you're going to live on in retirement is the number that minimally you want to have in your policy.
Wow.
Which sounds like a big number to people.
Yeah.
Right?
Yeah.
You're like, holy crap, that's a lot of money.
That's a lot of money in
right?
cash value
But it is what it is.
Yeah.
It is what it is.
Sense. I love it. That's a cool framework to think with, and I never thought about that rule. You know what's cool for me, Chris, is we're looking at my dad's retirement a lot. He's getting up there. Yep. He's going to be 69 this year, and Jennifer and I are buying the business, Nation's First Financial, from him. It's been amazing to mentor him. He's been an agent for 40 years, but he's always bought whole life. He has a good amount of whole life insurance. Awesome. To see these policies come to fruition, to see what they're doing in his retirement, these things generate. They've consistently generated this dividend for him. Yeah. And he's able to, if he wants, he can just take that dividend if he wants. Totally. I mean, it's pretty cool in terms of cash flow.
It's amazing.
Like, to have that kind of asset built.
It's a better bond.
Well, and you know what's cool is, like, interest rates are going to rise and fall. Right now, at the time of filming this, you can go get a bank CD at 5%. Yeah.
Sure.
But, you weren't able to do that for the last 10 years.
Right.
And who knows what the next 40 years, like you said, look like. Sure. In his whole life policy, the dividend's not guaranteed. But he's got it consistently on this old Met policy he's had. It just keeps coming. It's like, it's cool to see it as a form of cash flow in the way that retirement savers generally like to receive interest, like a CD. Just collecting that dividend is a pretty cool and valuable tool for my parents.
Totally. I love it.
So it's got a lot of use cases, not even to mention, which we didn't even go into, but we just did a whole 3-part series on the benefits of retirement. Like, people don't understand that owning more life insurance makes your cash flow efficient in retirement, because you can choose different options you wouldn't have chosen before. Like the pension, if you are lucky enough to get a pension, this is a big conundrum. Did you know right now 80% of Americans take Social Security and pension options to their detriment rather than their advantage?
I did not know that.
80% are taking their pension and Social Security wrong. And the determining factor could be life insurance. Because if you have life insurance put in place, you can actually take that full life, or what we call straight life option, get the higher income for you and your spouse, and then that life insurance replenishes your surviving spouse. Yep. Because the other thing that happens too is pension maximization. Yeah, the old pension max, right? Yep. Like, the other thing is sometimes people take the joint option. They'll take a reduced pension. The spouse predeceases them. Yeah. Now they're stuck at a lower option for the rest of their life. Yeah. So that life insurance benefit can have more efficient ways for you to use your annuities, use your pensions, claim your Social Security. Yep. It's powerful.
Yeah, it's amazing. So, I mean, that's all awesome stuff. When it comes to like infinite banking, right?
Yeah.
And when we're talking, okay, so 7 years, that's because we want to utilize it as a volatility buffer.
Yeah, we covered retirement well, but where do you get into infinite banking in retirement?
Yeah, I mean, the infinite banking, like, the infinite banking is just utilizing a whole life insurance policy, right? Like, in it's taking over the banking function. It's controlling opportunity costs. It's making sure that your safe, liquid, accessible capital is going to be beating inflation from a long-term perspective, that you can leverage it for whatever. I mean, think about a lot of people, grandparents.
Yep.
Obviously, if we probably have grandkids by that time or whatever. I know a lot of grandparents that want to contribute to their grandkids' college. I know a lot of grandparents that want to contribute to helping their grandkids start a business. And like, you have the ability, to me, this is where like the Rockefeller method kind of starts kicking in. You can start actually using your policy while you're alive to start to make that generational impact, right? And start kind of like guiding, the next generations, maybe not your kids, but your grandkids along. There's ways to do that, and like I said, you want to leave stuff behind, have everything in place. We mentioned on a video just a little while ago, doing family meetings, annual meetings, stuff like that.
Those are great.
Think about the dynamics. Like, you do these meetings, right?
Right.
And you do these meetings. How much different would these meetings be if you didn't have life insurance? They wouldn't exist.
Yeah, they wouldn't even be right.
They wouldn't even be a thing.
Yeah.
Right?
Yeah.
Think about it. Yeah. They wouldn't even exist. Yeah. And so, like,
it's crazy.
Having the infinite banking policy as, like, I mean, I don't know, because I'm 44, or I'll be 44. But I talked to, like I said, my grandmother just died. My father-in-law is 78, and he's got pancreatic cancer, so mortality's on his mind.
Yep.
Right? And he had a face-to-face battle with that, where he thought he had 90 days to live, and everything was like a real crisis for a very short period of time.
So scary, man.
And so when you face that and you realize, like, wow, this is like could be it, you know?
Yeah.
I think what happens, to me, having a proper infinite banking policy while you're growing and building wealth,
Yeah.
it's great to use. But when you hit retirement, to me, the best thing is start utilizing it. Like, you now have this foundation built that you can be intentional about what you're actually creating. Like, people don't realize it's not just the death benefit that matters. It's not just the money that you're leaving.
Yeah.
It's not, I can't remember. There's a guy, Scott O'Connell. He talked about it at Caleb's event last year. He's like, it's not what you leave from what did he say?
Yeah. It's not what you leave your kids, it's what you leave in your kids.
What you leave in your kids.
Yeah.
Right?
Yeah.
That's it.
That's legacy.
Yeah. Right?
Yeah.
That's amazing.
I love him, by the way. Shout out to Scott.
He's amazing.
He's incredible. Like, value creation kid.
Oh, man. Amazing.
Yeah.
Amazing.
App,
sorry for spacing on the name, bro. Like, I just, like,
great.
Here's the deal, though. He's awesome.
Yeah.
That statement, when I heard that, it was like, whoa.
Yeah.
You know?
So true.
And dude, you and I are really intentional about how we live life already. Right. And he was saying things, I was like, holy crap.
He made me go home. That
me too,
talk
man.
had one of the biggest impacts on me, for sure.
Me too. Me too.
Anybody with kids, it was like a shot to the heart.
Yep.
And
big time.
Yeah, we got home and started changing some things immediately.
And so what I would say is, if legacy is important, if your kids, if the next generation are important, and I think it should be. If it's not, don't have kids, please. You know, that's probably what's wrong with this world a lot, is people are just having kids and not being.
You need to have a license to drive a car.
Yeah,
have a gun,
I know.
pretty much do anything.
Yeah, I know.
Anybody can have a kid.
But what I think is, by having this infinite banking policy in retirement, it's going to help. Listen, it's going to help with your volatility buffer. It's going to help you if you need to leverage it in other areas, even to buy your cars. It's going to help you control your opportunity costs. All the principles of infinite banking will be there still. But the thing is, now you're getting closer to mortality. Now it's real. Now it's not about building, it's about transitioning. Yeah. Right? Maybe you're still building a little bit, but my guess is you've probably got that part down by now if you're 65, 70. Yeah. Now, having this policy as a foundation to your family, it was a financial foundation for your future when you were building it, right? Mm-hmm. We talked about the process and the hierarchy of financial needs and all that stuff, using it as your foundation. Now it's transitioned from being the foundation for your family or for you personally to being the foundation for your family. And you have an opportunity to teach to it, to start doing family meetings, to take everything that you've learned, and because you have this asset, you can actually lead by example, lead from the front, teach by leveraging and starting to use a policy. We have a new guy. I'm going to shout out to him. His name is Bob, and he's on the team, and he just became an agent with us. He got licensed, and he does this. He's an electrician. He works and does he's just a hustler. You know, he does real estate. He's got all these things going on, but he loves the infinite banking concept, and he's a builder. But what I think he does best from all my conversations with him is he's just passionate about teaching this to his kids. That's so cool. You know? And that's the thing I like the most, you know? And that's why I love having him on the team. That's why I love talking to him every time. He's like, hey, you got 15 minutes? I'm like, dude, you can always have my time. I love people like that. Have you ever
interviewed your kids?
Like on the channel?
Yeah.
No.
So, dude, it's so funny. I went to my daughters and we did an interview with them, and I asked them, like, what did they think about what I do for a living?
Yeah.
And my oldest daughter goes, Dad, we know life insurance. You always talk about life insurance.
Yep.
But it's pretty cool. It'd be fun to do that. Like, see what our kids think about what we're doing.
We should. That'll be fun.
It'd be cool.
But that's what I would say. I mean, it's not a sexy answer. It's not the hypey answer. But I would say it's the most important answer.
In retirement, they want security.
Yeah.
And that's what it can provide.
It'll give you security. Yeah. It'll give you peace of mind. Yeah. And it'll give you, to me, it'll give you the foundation that you can leave the impact on not just what you leave to your grandkids or your kids, but what you leave in them.
Yeah.
As Scott would say. So
incredible.
I mean, that's just keeping it really simple.
And opportunity cost doesn't change in retirement. You're still gonna have
that's what I was saying.
You're still going to have, float. There's still going to be things you want to
You're still solving all the same problems that you've been doing.
Same challenges.
I would encourage you when you get there, though.
Yeah.
When you do, take it and use a little bit. This money that's in this policy is eventually going to be passed down because all the cash value, because the policy is at a different stage at this point in time. Let's assume you've had it for 20, 25 years.
Yeah. Those things are
They're rocket ships.
They're cooking.
They're cooking.
Yeah.
Exactly.
I want to do a video where I show my dad's old Met policies.
Dude, that'd be amazing.
Because like people looking at retirement or people that are closer and go, I want that. Mm-hmm. I want that security. I want the ability to use my money tax free. I want the ability to have the benefits.
He's got Met policies?
He's got old, dude, these old
Met policies?
are
Can I speak to that for a sec?
amazing.
Can I speak to that for a second? So Danny is talking about his dad, and he's been talking about this for a couple of videos now. If you've watched the series that we've been putting together in this podcast studio session, and he's raving about how he's seen his dad's policies work.
Yeah.
Are all of them Met?
He's got others.
Okay.
But yeah,
but
his main two are like
okay, so let's just talk about MetLife for a second.
Yeah.
MetLife is like the worst case scenario of a whole life policy. They demutualized.
Yeah.
Okay. So even a company that when he bought them, I'm almost certain they were mutual
They're
at the
mutual
time,
when he bought
right?
them, yeah. They didn't demutualize till like the 90s or
early 2000, I think 2001.
Yeah.
So they demutualized.
Yep.
Right? And when they demutualized, he kept them there, and his policies are still screaming, even worst case scenario.
They're awesome.
Like,
yeah, they're solid.
That's amazing.
Yeah.
Right? Because they still, even though they demutualize, they still have the foundational components of a whole life check.
He is showing up as a powerful version of himself going into retirement. Like, he's confident going into retirement. He feels good about what he's built, and it's cool to see that. Like, I wish more people could see the end. You know?
And he didn't buy them for infinite banking. He didn't buy them for all like the ways that people buy them now and the way that we position them and the values and the benefits and all that stuff.
He's an entrepreneur and
he's leveraged them.
He's definitely leveraged them for real estate.
Right.
He's leveraged them for his business multiple times to expand the nation's first financial.
Yep.
So I mean, I've had first row seat to watching an entrepreneur use life insurance, and it's been amazing. But now seeing it in retirement, his needs are different. He's not looking to expand and grow.
No.
He's looking to make sure that his lifestyle is going to be secure for him and my mom.
Yeah. That's awesome. Yeah. And so he was able to take $1. When we talk about whole life being this awesome asset, we've done a lot of videos on it today. But one of my favorite things, and the one thing that we haven't said about it, is that it allows $1 to perform multiple functions in your life.
Yes.
Right?
You know what? You're right. That's the one thing I wanted to say in our whole life video that I didn't.
Yeah.
Was the reason why I buy whole life is because I'm somebody who loves researching and doing and trying to find some innovation.
Yeah.
Whole life makes me feel like my money's working as hard for me as I am for it.
Yep.
Because I can have it in multiple places at once, and it really makes me feel like I'm maximizing my results.
Yeah.
That's what's powerful about it, and that can help in retirement substantially because you need your money to do a lot of different jobs, like we talked about. It has a big responsibility. Yeah. So it can fill a lot of those voids.
I love it.
Well said.
But I mean, it's not a sexy answer, but that's what I would say. Like that's how infinite banking, that's how whole life will help you in retirement. It really isn't. And I would really encourage everybody. I always say you are where you are because of who you are. Use this opportunity when you have a fully capitalized policy. It's mature. It's screaming. Like whether you need to utilize it for your own retirement, there's going to be a piece of that that's going to go to your grandkids. That's going to go to your heirs, whoever that is, right?
Yeah.
I would encourage you to think intentionally about how you can split off just a little piece of that to mentor them and guide them and give them opportunity while you're alive, because any money that you would use for your heirs while you're alive out of that policy, that money is guaranteed by the death benefit anyway. That's all money that's going to go to them anyway.
Yeah.
So if we're talking about not just leaving it to them, but what we're leaving in them, you're never going to have a greater ability to make an impact than teaching them this system and this process and doing it right now while you're alive. That's what I would encourage.
We adopted the family constitution in our practice at Nations First a few years ago, and it has been transformative for families.
I love it.
To be able to sit down and talk about being intentional, writing out those signposts and things, those principles.
I love it.
It's really cool. We created our own. Our family's got it. It's a cool exercise to go through.
That's one thing I need to do.
The family constitution?
Yeah.
It's awesome.
I'll have to have you share information with me on that.
I'll share mine with you.
I've been looking. Yeah, I'd love it. I'd love to see it.
Yeah, it'd be cool.
It's amazing. All right, guys. That was an awesome video, I think, on infinite banking and retirement. Didn't get super deep into the technicals and the details, but once again, we've been just doing this podcast session today, and it's really been about the why. It's been about more the impact, and I think this is the stuff that doesn't get talked about enough. Too many people focusing on illustrations and too many people focusing on the raw X's and O's and numbers. And while those are important, none of that matters until you understand why you're doing what you're doing. And that's really what today's focus has been on. That's what this video specifically for infinite banking has been on. And when we talk about utilizing it in retirement, well, when we're in retirement, we're getting closer to the end. We're getting closer to, like, what is our legacy? What is our intention? What do we want to be remembered as? What is our impact on this earth going to be? And what better way to leave an impact on people than utilizing the resources that we've built to, like, make an impact while we're here, to mentor, to guide, to elevate, to teach, that kind of stuff. And so hopefully you found value in it. If you did, please like, share, subscribe, hit the bell, all that stuff. And if you haven't already, make sure go down below. I'm going to put a link to Daniel's page here, and go follow him. He's got a lot of great content. He's just an awesome guy, wealth of resources. Go check him out. Until next time, have a blessed, inspirational day. We'll talk soon.